Welcome and good evening, everyone, to our webinar tonight in English about retirement. What now? Before we start, let me just go a little bit through the program and through the organization of tonight. So today's webinar will take around 45 to 60 minutes, so up to an hour. And we also have, you can see that on the right, we have the chat. The chat is private, so that means only yourself and people of the Selma team, our financial experts that try to answer your questions in the chat, can see the chat in there. With the chat, we try to answer your questions right away. If they're more difficult or more into detail, our financial experts and financial planners will get back to you in detail over email later on. So let's go into it. Before we start, a short question about the audience we have tonight. So first, we're interested if you are a Selma customer, yes or no, or if you are retired already, yes or no. That gives us a bit of insights about the audience we have tonight. So very interesting here when it comes to retirement. We are pretty much at 50-50. So part of you already retired, half of the audience tonight, and the other half is not. And we have a majority of Selma clients here tonight. Also, though, quite a few that aren't clients yet. So I think we can explain what we as Selma have to offer to everybody. Before we go into the topic of retirement, let's briefly talk about the hosts. So tonight here with me is Stefan Jaecklin. Maybe you can say a few words about yourself, Stefan.
Sure. My name is Stefan. Hello, everyone. I've been for many years. I've been interested. Started into those questions, particularly the financial planning questions. It started with my PhD thesis, which I did as a young man when I didn't have gray hair, and was really interested in trying to figure out the more, let's put it this way, somewhat more scientific way of planning the finances for many years ahead. And it accompanied me through my initial activities in banking. I was then for many years a partner at Oliver Wyman and advised private banks in their processes and their ways of advising clients. And then joined also a few years ago Selma, where I'm very closely together with Patrik, developing precisely what I like, which is those questions around financial planning and making it a little bit more scientific and more robust.
Excellent, Stefan. Great to have you here tonight. A few words about me. I think a few of you might have seen me before. I'm Patrik. I'm one of the founders and the CEO of Selma. I'm also responsible for our financial algorithms and our investment allocation. So I can also give you a little bit of background how the portfolios and how the investments are actually connected to the retirement. So let's dive right into it. For the ones that aren't Selma clients yet, just a very short introduction about who we actually are. Selma is a digital asset manager, and we provide investments, but we also provide Pillar 3A, probably a bit less relevant tonight if you're already into pension. We do automated asset management with ETFs, funds that are very fairly priced, very broadly diversified, and we offer AI-supported financial advice. That's us, that's our team. We're a team of a little bit over 20 people from 8 countries based in Switzerland and Helsinki, where our product development is based. We have almost 15,000 clients. So probably after this webinar tonight, we'll be getting there. We manage 360 million Swiss francs, have investors like Micro and TX. TX is formerly Tamedia, a large media house in Switzerland, and are a pioneer in offering AI-based advice. I will also talk about how this is connected to retirement. Okay, when you know Selma, you know that we probably came from, I'd say from another perspective originally. So our clients originally have been wealth builders, young professionals. You can see them here on the left, and their focus predominantly has been on growing their wealth over the next decades. Often people that have still 20, 30, 40 years to go until their pension. And the focus here really has been simplicity, automation, and then long-term growth of their wealth. We also figured that we have been seeing more questions and demand out of a different customer segment, and that's also why we are here tonight, which are pensioners, and them having a different view on the whole topic, and probably also a different need, also a different risk tolerance. We're gonna talk about this tonight in depth. The focus here is more on pension planning, being able to have enough money to retire comfortably, and also another view on the risk side, where the focus is much more often on capital preservation and not so much on growth anymore. Good, but that's enough about us for now, and now let's go right into the topic, Stefan. So, getting closer to retirement or already being in retirement, what do I have to pay attention?
So you're obviously asking that question to me, right? Because I have got those gray hair, and yes, I'm not yet retired.
I'm asking because you're an expert on the topic.
Exactly. I'm not yet
retired, gray hair as well.
But I have all those questions that come naturally to me, but also that I have been wondering for a long time, because actually this point of retirement is a really, from a financial perspective, it is an incredibly important and incredibly difficult time. So first of all, if you get retired, you're all happy. But the next day you wake up, you are certainly going to have all those questions. And I hope you ask those questions before you get retired, which really is relating to everything that suddenly you are in charge. Because let's think this through. When you up to retirement, you have income coming from your job, of course. And, you can have a shortfall in your wealth when you're 40. You can make it up until you're 65. You can even correct a certain number of things when you're 50 or 55. But the closer you get retirement, the less room of maneuverability you have got, because you do no longer have that lifelong income. You still have possibly a rent income, a retirement income, but suddenly from one day to the other, you are far more in charge of your personal financial future than you were ever before. And therefore, all those questions are coming up. How do I invest my retirement savings? That's an obvious one, but the most important one is certainly, how long will actually my savings last? Will they outlast me? How do I move over from the second pillar? Should I just move this over once or over stages? How do I generate income from my assets such that actually I do not have to start selling all the time my fortune down until there's nothing left. When do I pay out of the third pillar? Can I still afford my lifestyle? Those are actually, quite fundamental questions, and they go very, very deep. They can keep you awake at night.
And that's also what we see, I think, in the practice, right? So that those are real questions. They're not like we didn't make them up because they fit nicely on the slide, and they can also be quite life-changing or drastic. So when we talk about lifestyle, it can really mean there like changes needed or like in any direction, right? So you can probably afford much more than you think you can, or the other way around. I think we've seen both of them.
And those are all questions that fundamentally relate to something that the financial industry does really, generally not like to talk to you because they find it's threatening. But this is risk management. All those questions are related to risk management. And risk management is a cold mathematical approach to planning your expenses, your income, or your assets many, many years ahead. And the good news is that's all feasible. You just have to calculate a lot, and you have to keep, le sang-froid. You have to just really analyze this. Now, a few things along the way that are really important. While this is all threatening and intimidating at some point, I think, first of all, it's really, really important to just become aware of the change ahead. The responsibility of your future really shifts to you in a very drastic way. Another part is the budget planning. That's something that most of us have never done, right? Because we assume that more or less things work out at the end of the month. But actually, since at the end of the month, there's no pay slip coming anymore, you really need to start planning your budget. You need to also plan, of course, in this, your expenses. And with this, you have to ask yourself the question, what actually is the amount of money that I need? You'll need to observe deadlines. There are certain deadlines for certain things, like all the payments that are coming out of your pension fund, the withdrawals of those money. That's all a question that, is related to certain deadlines. The investment plans, what and how should I invest all of this? And least but not last, your own risk tolerance. How much risk are you actually willing to take? Depends on your time horizon. Depends also upon your view of intergenerational wealth. That can also be a topic. With this term, I mean, if, for example, your children, your descendants, that's part in your wealth planning, in your retirement planning, then that changes also the risk tolerance a little bit. So all of those questions, but I think the very first one is just become aware of it. And the pure fact that you are joining this call is obviously, showing that you do care about and are aware of the change.
Yes, probably also out of the practice. I talked about budgeting also with a few of our clients. I think you said obviously there is different ways how to do that. So you can build a budget kind of building up, right? You see, okay, this is what I need for rent, this is what I need for food, this is what I need for health insurance, and you build it up. But I think you said a very interesting word, which was observe. So I think what at least one of our clients that I have spoken to, they have observed their spending behavior over the last 2 years, and they're usually, with most banks, you have quite good tools for that. So I think quite a good way to look at this is to like not only do this bottom up, but to also look at your actual like spendings. How have you like spent really, like in reality, not what you think it is, but what it actually is, and that gives you a very good baseline. And then maybe second point, don't forget about the taxes. So, and the taxes, especially, I think most of you might be aware of that. Also, when you take out money out of retirement funds, this money is being taxed. Depends a little bit on which canton you live in, on how drastically this is taxed. But this can obviously also play a factor in the decision, but it can also have an impact on the planning. So it's just something that you should be aware of, that the tax situation with the pension money, but also on the planning side, it's something that is probably going to be a little bit different from what you were used to in the last years. Okay, let's go a little bit further. So investing, Stefan.
Yeah, well,
should I, or here it says a reason, but like, should I even like, why should I even invest after pension?
right. I think that's the amazing thing. I mean, all those questions before intimidate people so much that they then, a lot of them, that's actually surprising the amount of people who do that, who just don't invest. They think it's safe to keep the money in cash.
That's
Well,
like on the Sparkonto, right?
exactly. Well, that's actually probably the unsafest way, because yes, you do not lose a lot. You think that's true in nominal terms, but you know, on the end of the day, if you have 30, 40 years ahead of yourself, well, then you really need to worry about inflation, and it won't be all the time that we have inflation as low as we had in the last few years. But you know, every percentage of inflation essentially lowers your wealth by 1%, and means you will have a shortfall vis-a-vis your expenses. Not investing also means that you have no chance to close the pension gap. And that is also an issue that you need to address. So finally, the question here is really a risk management question. It is very honestly a mathematical question that needs to be addressed, that we fully understand, and we do not expect clients to do the math behind this. But that's what Selma does. We do the math. And of course, you will then need to decide what types of risk you're taking, but you should always be aware of the, you know, the growth of wealth that you achieve vis-a-vis your expenses based on different types of risks. And what we do is we provide you that transparency.
It's really interesting that you say, okay, the unsafest way is probably to leave it on the bank account. Sounds very counterintuitive, right? Before you go into the reasoning, as you think, okay, like what couldn't be safer than a bank account?
Yeah, you just always forget that we're talking not 1 year, we're talking 30, 40 years. And that is the issue. That's what's hardest for most of us to think, that effectively we're talking very, very long time spans.
And I think that's also when we go to about the investment, right? That's what makes the investment safe, right? Because it's just the other way around. The investment might not be safe for 1 year or 2 years, but even in retirement, like at least for a part of the money, you still have quite a long time, right? So well, probably not anymore if you're 99 and not in good shape, then also your investment structure should look probably differently. But if you're 60, 65, there is still like a couple of 10-year periods ahead of you that make investment still the safer choice than the bank account.
And Patrik, the fact that many people think investment is not safe also comes from the fact that when people talk about investing, they have got those discussions about whether they should put a lot of money into, I don't know, Meta or whatever company. Well, this type of stock picking, this can make you rich, that's true, but it can also make you very poor. And we do not at all advocate that sort of investing. We are again looking at this from a risk management perspective where diversification is really critical in making your investments. And the realization that the world is chasing, with huge computers, etc., is chasing any valuation differences really, really quickly, and that you as a retailer are probably the last one in the queue. So all of this means, this is really difficult, tricky ground. And so it's not surprising that Swiss Life, in a study on retirement, found out that half of the people just don't know what their financial situation will be like after retirement. So really actually a frightening gap of realization, of awareness at a point in life that is actually really a critical transition.
Very interesting. Thank you, Stefan. I will now go a little bit deeper what we actually offer for retirees as Selma. Basically, the offering we have has three pillars, same as a very famous three-pillar system in Switzerland. So it starts really with the support and the advice on decisions. So you might have seen Selma AI, which is our AI-based advisor, and that can give you help and assistance with planning your pension and answering questions. We'll see that as, okay, do I have enough money? Should I invest? How much can my pension gap be? And so on. We also have expert advice on pension planning. We have also human experts that can help you with that. So it's not only the artificial intelligence that can help you, but also let's just call it the real intelligence that can help you being set in the right way. And then eventually you talked about that for at least for many of you, it might make sense to invest some of the money, maybe not everything, that those things can be calculated. What kind of a share of the wealth should be put into investments? What should probably be kept in cash? And for that, we have a special investment solution for retirement. And that investment solution, gonna talk about what it does a little bit later, is a custom solution for retirement money. So it has what we talked about before. When you look at the client that is 25 and like saves for growth, this is a little bit different because it looks at these specifics in retirement where you might need to have some of the money that you have built over time. You might want to take some of that back, and you might need some return and or even like some use of the capital that you have built over time. So you might need to withdraw capital also from your portfolio. And then in the end, there is also constant support and a tip. So this is an own user experience that is dedicated for pension, where you have tips and advice that are dedicated for the pension situation. Obviously, this also includes always being updated about your pension situation. I have worked for a big pension planner in Switzerland, not going to say the name, but it's like the big one. And there, people came in to refresh their documentation every year, and then they got another pack of just like 50 pages of like recalculation, because your wealth, even after pension, is not going to stand still. It's going to develop. It's going to move a bit with the markets if you have invested it. There is still going to be like maybe years where you need more money, years where you need less money. So it's still going to like move. You might have real estate that you're going to sell at some point. So there's still changes. So it also needs to be updated. And all of that is then also done within Selma, this update. So you don't basically need this 50 pages of paper anymore. This is how this looks like. There is a new mode, a new user experience in the Selma app. It's called pension mode. We also call it very free pension by Selma. And I will talk a little bit about what this includes. So first, classically, you have a chat with Selma. I think the ones that already our clients have already given us probably most of the information we need. So that means there are a few extra data points that we will need if you go into pension. And those are things like, okay, how much money will you get out of your the pension providers like your third and your second pillar. It also includes things like how much is your gap, how much do you have to withdraw from your wealth every year. Then we adjust your strategy based on that. So we calculate, basically now it gets maybe a little bit technical, but we calculate the money that you're going to need in the future is, in a mathematical sense, it's a debt to yourself. So money that you owe to yourself that you're going to need from your own portfolio. And we model that in the background, and we look how can we protect your debt to yourself. How can we look that the assets you have match this debt? It's not that complicated if you actually go through the app. You will see this new setup that might change or might also not change, dependent on how your wealth situation is. And then you will receive ongoing tips and recommendations from Selma. Let's talk just very briefly about the investment strategy. So as I said, there are adjustments that are appropriate to your age. So the risk might reduce with increasing age. That's what I said before. So if you're 60, you might not need the same portfolio as when you're 70, 80, 90, right? You start withdrawing, your wealth gets less, and also your investment horizon gets less. There is risk management. So that's exactly what you said before, Stefan. So there needs to be a split between short-term liquidity, the money you need right away, the money you have already pre-planned, probably for a nice holiday or travels or like whatever your plans are, and then a part of your wealth. It's not going to be everything as with the 20-year-old, but a part of your wealth that can still be into growth. Then strategic sales, this especially if you need money out of your portfolio. It often doesn't make sense to like sell everything at once, right? So it might make sense to withdraw over time, to do basically the same when you build wealth. You might know this dollar cost averaging means you buy at different prices, so you're less dependent on the market movements, and you can do the same if you sell. So you sell at different prices, so you're also not so dependent on the exact price at a certain point in time. Then portfolio optimization. This is the ongoing adjustments of your portfolio. Also to the market, that's a risk management question. So you might know that if you are a Selma customer, we do adjustments to the markets as well. So if markets are very expensive, that's, as an example, what we see in the US right now, that markets are expensive, that we buy less of those markets currently, and that reduces the risk. And then there is also in pension that we recommend that we focus more on Switzerland, that you have less of a currency risk, also makes sense, especially after your pension, as in your pension provider, so your third and second pillar, often they invest very heavily in Switzerland. That might be up to 60% that you have invested into the Swiss market. If you take that money out, you don't want to increase the risk. You don't have this bullet in Swiss assets anymore. That means also in your private wealth, you can now invest more into the Swiss domestic market. It's also now, again, a bit technical, is usually what matches your pension debt the most, as your expenses that you're going to have in pension are most likely going to be in Swiss franc if you live here.
At this point, maybe simply, I'm sure that many of you are confused because it's difficult to follow. The good news is really you do not need to know any of that stuff. That's precisely the point of Selma. What Patrik and I want to bring across is these are the challenges, the risk management and mathematical challenges that Selma solves for you, and it solves for you individually. It doesn't solve for you as a group or as whatever a standard customer. It is really your own situation that Selma captures and does all those reflections that Patrik just did. Does for you without you needing to do any of those things. You need to talk to Selma, absolutely, but Selma will talk to you in a conversation that everyone can follow. I assure you, it's a pleasant conversation.
Thanks, Stefan. So here I have brought an example, and I think that's very, very important what you just said. This is an example, right? So this is Anna, a retired doctor with a pension gap of 30,000. A pension gap of 30,000 means Anna will need 30,000 out of her wealth every year to maintain her lifestyle. So this could be that she gets 70,000 out of her second pillar annuity and her AHV, and needs 100,000. That would mean she needs 30,000 out. And for her case, we see that there is a shift in her portfolio. We go more into now investments that maintain their value, that are a bit safer, that also then are more in this like capital maintenance mode, it's called, right? So her goal here is to maintain her capital over time, still achieve a return, but not so much to grow it anymore. And this might, though, like if we do that for you, Stefan, or if we do it for any one in the call, it might look very differently. It might even mean that you don't need to reduce your risk, right? So if this would not be Anna, but it would be Peter, let's just say, and Peter doesn't have any pension gap. He's fully covered by AHV and his second pillar, and he has a big wealth, and probably he doesn't even want to spend all of that and wants to pass on the majority of this wealth to the next generation. We basically know, okay, this money is going to be not only invested for the lifetime of Peter, but probably even longer than his life. So Peter, if he can sleep well at night, that's another criteria that we looked at with the risk willingness, right? That means Peter could still have a quite risky portfolio. And that's the adjustments that we do over time. And by the way, I said it before, also Anna's portfolio or setup is going to change because there is a 67-year-old Anna. In 10 years, there is a 77-year-old Anna. In 20 years, there is an 87-year-old Anna. And maybe there is a 97 and 107 years old Anna at some time. And the wealth situation is going to change on the way, and that's exactly what would be adjusted. That we look, okay, how long is the life expectancy? How does this pension debt look like, and what adjustments would need to be done in Anna's case? There is also a few adjustments that you can do in the Selma app. So there is a possibility to have a sustainable portfolio. There is also a possibility to have an income portfolio, and that especially makes sense if you withdraw money from your portfolio. So this means we actually aim to provide you a stream of dividends and income that is then ready to help maintaining the lifestyle over time. Good. Now, why choose Selma for retirement? Always have to say, as a founder, I'm obviously like a bit biased here. Maybe you should do that. I think it's quite a good idea. But I think also the arguments here really speak for themselves. So it's a personalized investment strategy it says for retirees, but that's actually not enough yet. It's a personalized investment strategy for every single retiree that is different. There is support via email, chat, and phone. That also includes financial experts that can also answer some of the probably more complex question. It's not just I forgot my password, but it's also financial questions that you can ask to us. There is different portfolio options. There are also tools in the app now where you can simulate certain scenarios. So you can look, okay, what kind of spending rate do I have and what would that mean to my wealth? So you can play around and see, okay, if I take out 4,000 per month, how is it going to look? If I take out 10,000 per month, how is it going to look? There are flexible payouts and withdrawal plans. It's something that we also just have released in the mobile app. So you can also now have recurring withdrawals. You can not only tell us I need 10,000 at once. We've always been very flexible also with paying out money, but you can also automate that now. So you can have a plan and say, okay, I need a certain amount every month. We automate the management of the portfolios in the background, which makes it really efficient. And then there is tips and recommendations from Selma AI in the pension mode that talks to you about things that are relevant for you as a pensioner. Then important question, right? What does this personalized offering cost now? It's a bit dependent on how much you invest. So it's you can see it here on the slide. It's between 0.55 and 0.42%, calculated on the wealth you invest. Quite interesting here. This is, I would say, dependent on who you look at. With the old, can I call them old school providers, like the banks and the insurance companies? You're at a fraction of the cost, so it can be like a third or half that, depending on who you choose. Can even be less than a third if you choose completely the wrong one. But on a fraction of the cost, you get a very individualized mandate here, very reasonably priced. Good. So for the last couple of minutes, some questions that we have sourced from our clients about retirement. Stefan, okay, good. Let's fast forward. I'm also going to fast forward 20 years or so. Now I have gotten this money out of my second pillar. I have saved something. You told me the bank account is very unsafe. I've understood that. But how much should I now invest? What is
Well,
the
it's
right
exactly,
amount?
that's now exactly the very first question, right? I have got those savings, and how much should I invest? To be honest with you, that's a very, very personal question. And with this, I mean, you are different from everyone else. You need to tell me how much you actually have, how much income you're getting from your pension plan, how much income you're getting from the AHV, how much you want to spend, how old you are. There is a plenitude of questions until I can give you that answer.
But how do I find the answer now?
Exactly.
You just told me there is so many questions. What is the answer?
There are endless questions, and you could think, well, okay, now I get out of this meeting because obviously they're not going to give me an answer. Well, we give you the answer, and that is precisely Selma. Because again, this is, believe it or not, but this is a mathematical question. It's actually a very demanding question because you have got to figure out your balance sheet, or we have got to figure out, Selma needs to figure out your balance sheet, your life planning, lots of factors that it can calculate and that it can then use to generate the wealth plan that corresponds to you. And rather than developing something really complicating and not being able to communicate that to you, it will actually give you an answer in seconds after having done in milliseconds all of those calculations that would take you days. And it gives you the answer. You can barely read the answer on the right-hand side, but it speaks to you as a consultant would speak to you, except that he knows a lot more than any consultant would ever know. Well, that's my turn now, right, Patrik? You're grilling me,
yes.
like you. So, one of the things that I'm really worried about is, how much cash should I keep? You told me inflation is really killing me, but at the same time, I do need some cash, right?
Yes. So I'm not going to do it the same way as you did and just ask more questions. Actually, gonna try to give an answer, at least a rule of thumb. So what we see here is that it's also it is dependent and it is individual. That's very important, right? There is never all fitted all answer here. However, what you can say, if you have your pension gap, so you know how much difference you have that you need from your wealth. So as an example, you need 100,000 and you still have an income of 50,000. You have a gap of 50,000. And the rule of thumb is that you hold somewhere between 1 to 3 years of your gap, dependent on your risk tolerance. So that would mean if you have a gap of 50,000, your cash buffer would probably be somewhere between 50 and 150,000 that you hold as cash. And that's if it's 1 year or 3, that's dependent on how big is your risk tolerance. And then on top of that, you also hold cash that is already earmarked for something. So if you say, okay, next year I'm gonna go on a big cruise or a big travel, it's gonna cost me 25,000. I wouldn't really invest that. So you add those expenses that you already know for sure, not the ones that are in 25 years. You don't need to put them aside right now, but if they're in the next 1-2 years, you take them out and you add them to your cash buffer. So now, if you want to know the amount that this would be as a result, again, it's a computation, and surprise, it's also one of the things that Selma can calculate for you. So what Selma would say would be close to what I have explained, but what we would add here in your personal financial advice is that we would feed that with the financial information, so you would actually also see the numbers in here. Good. Let's go to the next question.
Well, that honestly, for me, and I guess for you, for everyone, that is probably the single most important question. Will I outlive my savings? Because that is really the nightmare of absolutely everyone. And again, that is, as you could expect, there is no standard answer to this. Again, this is a mathematical question that's relating to a lot of elements that need to be modeled. We need to model wealth. We need to model your assets. We need to model your expenses. We need to do all of those things. It's actually a complicated task. There is also inflation that's eroding away your wealth, making your expenses higher. All of those factors need to be factored in and taken into account. And once you've done that, and that's exactly, again, what actually Selma does for you, you get the answer. And Selma, the same way as always, will provide you an answer. It does it in language, but it also shows you actually what, given your own situation, given your withdrawals you have in mind, given all those elements, how long actually the assets will be sufficient to support your lifestyle. So that is, again, to me, this is something that is important and that Selma updates you on a regular basis. So, for example, after a crash, after a very heavy market movement downwards, for example, the first thing I would do is check out Selma and see how that has affected my personal wealth situation. And the opposite is obviously also a happy one, where effectively I see that my assets are keeping me afloat longer and longer because markets have developed well.
Yeah, that's precisely also, I think, what we have talked about before, that this is probably a question you not only have once, but you have ongoing, right? You want to know, like, is it still enough? Am I still on track? Do I have to change something in the spending behavior? Like, can I spend more? Can I spend less?
And that's the nice thing about Selma. She is awake 24 hours, 7 days, and is always up to speed on your personal situation. There is no lack, no nothing. She knows what the situation is at any point in time. And she does not throw figures at you. She can, but she actually talks to you.
Very good.
Well, then, Patrik, I mean,
yes.
This is something that affects quite a few people in this call.
Yes.
And a number of in this call are already receiving a pension.
Yeah.
And therefore, why do I need Selma?
So you mean basically, I think also if you don't have a pension gap, right? If you kind of like, if you're already, should you still go into this retirement mode? The answer here is yes. So
as an unbiased founder of the company, yes.
As an unbiased, exactly, yep. and the reason is in the retirement mode, as said before, we will actually look at your unique situation, right? So it will check, do you have a pension gap? Yes or no? How big is it? How big is it in relation to your wealth? And then we'll give you a unique setup for that situation. So I think I talked to a few clients that said, okay, like I don't want to have less risk. So I don't want this safe mode. It's actually not a safe mode per se. It can be if this is what supports your situation the best. But it can also be that you can still invest into a growth mode dependent. As I said, it might probably look differently for everyone in this call. That's one side. So it's really adjusted to you. And that's why we recommend to also using that. And then the second part is that you get the user experience that is then also customized to your retirement. So the questions that Selma AI will show you, also the different topics you will see there, that you no longer see a pillar 3A. This is made for the retirement situation. So regardless, I think what your unique situation is, it makes sense to be in the retirement setup, because the retirement setup is actually going to check for your unique financial situation. And that was an unbiased my unbiased opinion. Okay, so now for the ones that aren't clients, here there is also, if you want to try out Selma, there is a benefit here that you would get a start bonus when trying out Selma, and you get a free financial checkup. Obviously, the free financial checkup you can also get if you are already a client. So if you have questions that go deeper than what we were able to discuss here, or you want a financial expert of ours to look at your unique financial situation, even after you have also talked to Selma AI, but you want somebody to review that and look if this all makes sense, this free financial checkup is also available for you. Yes, I see we had many questions in the chat. If your questions hasn't been answered and you have asked it in the chat, we will get back to you. So we will write you an email and help you with that questions. Also, always, if you have further questions, you can reach out to us directly, also here, but also in our customer support chat. And that's everything for tonight. First, thanks to you, Stefan, for sharing your insights and your expertise with us in the last 50 minutes. And then obviously also thank you to the whole audience and everybody of you that has joined us tonight for maybe rather dry, but still very important topic.
Thank you,
very
everyone.
much. Bye-bye.